Hey, good morning, John. Thanks for joining me today on this interview. I was just excited to have you on to go through the entire process of getting a mortgage. Buyers always have questions as to, hey, what are the exact processes? And usually people know like the first step to get started. And then after that, they're kind of like lost. I'm looking forward to just having this interview to just go through every step of what the process is. And just to throw some street cred to you, John is my primary lenders. We've been working together. I was thinking about that before this interview. I can't recall. I know we first crossed paths when I had your kid in youth group back in the day in like
Right.
2003 or something like that. So, and then we've been, working together then. And John, I can honestly say that you have the follow-up of that exceeds any other broker or mortgage broker I've worked with. So I never have to wonder what's the status of a loan file when working with you. So I appreciate that, John. So thanks for being on the call today. And
Thank you, Tony. My pleasure.
yeah, cool. Yeah, and so just kind of ask you a handful of questions here. Just will guide us through the process here. And to all the viewers out there, make sure you hold on to the end because John's going to give a story or two of some like war stories in the business as to you think you're all ready to close and then this happens. So make sure you hang on to the end. So cool. Yeah. Could you, John, for the viewers to get to know you a little bit, can you talk about your experience? Like, what do you do? Your mortgage broker? What does that mean? Like, how long have you been doing this? And just kind of introduce yourself, please.
Thank you very much, Tony. And hello, everyone. It's my pleasure to give you some information today. My name is John LeRose, and yes, I'm a mortgage broker. And I've been working in the industry for close to 25 years. What I do is help hardworking families secure mortgage financing for the purchase of real estate properties, primary residences, investment properties, second homes like summer homes, condominiums, things like that. And I also assist with refinancing. Refinancing is something that a homeowner can do after they purchase a property if there's a benefit to them, like saving on the monthly payment, lowering the interest rate, or maybe getting money back to do home improvements or pay off credit cards and things like that. I probably close about 125 loans a year on average, and it's just a wonderful opportunity to help families who, want to purchase a home or refinance a home. Much of this information is not taught in schools, even at the college level, even if you're taking finance classes. And I think a lot of times folks maybe aren't sure, like, what's a good credit score? How much money do I need to put down? And so I'm happy to take all the time in the world to answer questions that people have so that you're fully informed. Because when you have information and you have a loan officer that explains things to you, then it really takes down the anxiety level and it lowers the stress level because you start to feel like you understand what's going on and why things go the way that they do.
Okay, cool. Yeah, and so starting off, getting into the weeds a bit here. All right, I'm thinking about buying a house and I know I need financing. What's my first step?
Well, the first step is to gather some information that's needed for the mortgage pre-approval. You don't necessarily have to bring documents together at this time, unless, of course, you're just not sure how much money you have in the bank account or how much money that you make. But the information that you need to apply for a pre-approval would be your income and your assets, and then the credit scoring we obtain through a soft pull program. And what that means is that you don't have to worry about your credit scores being negatively impacted when you apply for a pre-approval. Consumers are always worried about that. And I can assure my clients that when we pull your credit, it's a soft pull and it doesn't hurt your scores. But those scores are very, very important when it comes to the pre-approval process.
Okay. And you talked about assets. So is that like bank statements or something? That's how much you have in the bank generally?
Correct. Assets would be how much money do you have either saved up for the house purchase? Money to purchase a home can come from the following sources: your checking, your savings, investment accounts like maybe mutual funds. Many folks have a 401k for retirement. Most retirement plans allow for withdrawing money for the purchase of homes. You can also use a federal income tax refund. You can use a gift from someone close to you. There is down payment assistance available. You do have to qualify for it. And sometimes folks get creative and they might sell a vehicle to get money to purchase a home. And I always tell them, check with me first because I'll need to advise you on the type of documents to gather in that sale to show the underwriter where that money came from.
I've encountered that a couple of times too. I think it seems like if it's within like 60 days or 2 bank statement cycles and there's a sudden deposit that's usually not on a monthly basis, then they'll ask for a paper trail on that. And it sounds like that's kind of what you're talking about.
Correct. Most deposits in someone's bank account is from their payroll. And if someone, typically makes about the same amount of money, then those deposits usually are about the same dollar amount. So here, when you have a deposit that's outside of that normal dollar amount, it's kind of a red flag. The underwriter is going to look at that, and a good loan officer would look at that and say, Mr. and Mrs. Buyer, where did this money come from? So that way we can source that money and we can show the origin of those funds. And that's actually in the Patriot Act. That's legislation put forth by Homeland Security, because they want to make sure folks are not using illicit funds to purchase real estate properties.
Yeah, and then so in the financing process, it's generally a two-step process, and you get your pre-approval, and then after the pre-approval, then there's this process to actually get or clear to close. And can you just talk about the difference of that? So how do I get a pre-approval, and what does that mean exactly?
Absolutely. So the pre-approval it's very important. And essentially, here's what you would do to apply for a mortgage with me or Guaranteed Rate. We have a digital application. So you could use that means to apply. I would send you my website, and there's a red tab under my picture that says apply now. You click on it, the application opens. I ask everyone to fill it out completely. Make sure you click the box that says you have good credit. You can put whatever sale price you want. When you're done, I'll be able to go in, make any changes or corrections, and then I can structure the approval either based on what you qualify for per your debts and income, or I can structure the approval based on your monthly payment tolerance. What I find is that the allowable ratios can result in a payment that's higher than maybe what most people feel comfortable with. And as a consumer, as a home buyer, you're smart to stay under your affordability, not only so that there's no issues buying the property, but you have a little bit of disposable income to do some renovations and, maybe go out to dinner once in a while. And so that's important as well. But in terms of the physical process of applying, you can either use your phone and you can apply digitally, or you can apply using email, or you can call me up on the phone and we can take your information over the phone and fill out the application over the phone. Whatever way you choose, whatever way you feel most comfortable with, to get the actual approval document takes about an hour.
So I fill it, say I'm applying, I fill it out, and then you get prompted that, hey, a new application's been filed. And then from about that point where you look at it, then within about an hour, then it would be pre-approval. Is that right?
Correct. If all the data points are inputted, and that is, your income, your assets, your employment, your work history. Generally, we look for a 2-year work history. Interesting note for college graduates: college counts as a part of that work history. So if you've just graduated, and you get into the work world, and you say, John, I don't have a 2-year work history, I was in college prior. That's okay. But the idea is that with those data points, then absolutely, it's no problem for me to have that approval to you very quickly. And part of what we do in the approval process, and we look at income from the affordability standpoint and debts. An interesting note, a good thing to keep in mind, if you remember only one thing from this conversation, is that for every $5 in monthly payments, that's equivalent to about $1,000 on the affordability. So let's just take out the calculator here. If you have a $600 car payment divided by 5, that's about $120,000 on your affordability. And so paying down credit cards, if you're thinking, I want to buy a house maybe in the fall, what should I be doing now? Absolutely. Pay down those credit cards. If you have a high car payment, consider maybe refinancing it, that type of thing. But if you do carry debt, then it's always good to pay that down. And it's those factors that are dropped into what's called an underwriting engine. And the underwriting program that we use is endorsed by the federal government. And so this is the program that all banks and mortgage lenders use. And by dropping your loan factors into that program, the things that we just talked about, the program will read that and it will approve you, or it will suggest how we can get you better positioned to purchase a home. And, I've had folks over the years that maybe quite weren't there yet, and I always will take extra time to advise, here's the action steps to take and complete so that you can better position yourself to get approved. And so never worry, gosh, what do I do if I'm not approved? There's some things that we can always advise that you'll be able to do that will get you in the position to be able to get approved. As I had said before, there's no cost for the pre-approval. When you have that document, you can confidently go out and shop for homes. Remember that a seller is nervous too. They are certainly interested in your offer, but by accepting their offer, they're putting all their eggs in your basket. And so they're definitely going to want a pre-approval letter, because they're not even going to consider your offer without a pre-approval letter, especially if you're competing against other buyers who do have a pre-approval letter. So it's super important that you do have a pre-approval, and the fact that there's no cost or obligation, that's no problem. But I tell everybody, when you're out shopping for homes, if you find something you like, send me a text. Let me know the property address. I'll be able to give you an idea of what your monthly payment will be, estimate of how much money you might need for closing. That way you feel confident and comfortable knowing that this is what your monthly payment will be, and then you can confidently make your offer. I'm always happy to call up the listing agent and say, these folks are solid. We've proven their income and assets. We got them approved by the underwriting program, and I have a good reputation in the area, so sellers know that my approvals are valid. And in terms of getting you cleared to close, when I have responsive clients that provide documents in a timely manner, we'll have you cleared to close in just 2 to 3 weeks. So it happens very, very quickly. And yeah, it's an effective process.
Yeah, cool. And this a couple of this case studies that we've worked together on. Lots of different ones are coming to mind, but on the note of somebody not being able to qualify at the time, but with the right strategy they could. I know we had one buyer who bought in Glenwood, Illinois here, and they couldn't qualify like as their current snapshot of like credit was, but you were able to guide her to say, hey, all right, here's what we have to do. We have to strategize that you have your credit card balances are too high, and your credit card balance, it's not like the dollar amount wasn't that much. It's like they had like a $5,000 limit and they were using like $4,000 or something. And so the money wasn't that much. It was just their credit utilization.
Correct.
So at closing, they just had to pay down those balances because they had money. It was just that when you use, I think, what is it? Like you use more than like 30% of your available credit cards, like that's when it starts hurting you. And so there was
Correct.
some strategy there where like, oh, hey, instead of putting all that down payment money into the house, keep 10 grand. It was like $10,000 or something, and then we'll pay down those credit cards at closing. And then there's something like we couldn't do it in advance because there just wasn't enough time. So they so that was kind of neat.
Let's talk about that a little bit. What I love about Guaranteed Rate, the company that I work for, is that we are allowed to have home buyers pay off a credit card at closing. And again, remembering that formula, for every $5 in payments, it's $1,000 on the affordability. The nice thing about having folks pay off a credit card at closing, there's less documentation than paying it off up front. And as a result, we can hit that target sale price to make it happen. The ratio that you spoke about is called a debt utilization ratio. And from a credit scoring standpoint, it's super smart to keep your balances on your credit cards under 20% of your limit.
20%.
And it's funny because consumers think that, gosh, I should use up this amount that I have, this limit that I have, so that it will help my credit scores. But it's actually the reverse. Once you go over 20%, your scores drop a little bit. Once you go over 50% of the limit, your scores drop more. Then when you're over 75%, or you're knocking on the door of the limit, or you're at the limit, then your credit scores are dropping fairly significantly. And so that's why, again, if you're thinking, I'd like to buy a house, I'm tired of renting, maybe in the fall, then a great thing to do now is to go ahead and, pay those cards down under 20%. Not only will it help your affordability, but it's going to help your credit score go up, which has impact on the interest rate pricing that you pay and stuff like that.
Okay, cool. And then can you talk about the different mortgage types? I'm sure there's more than I have made note of here, but I know we got conventional, insured conventional, FHA, VA, there's like USDA. I'm sure there's a smorgasbord of others, but the main ones, as I understand it, is conventional, insured conventional, FHA, and VA. The ones you generally see, and can you talk a little bit as to what the difference are between them?
Sure. Conventional and insured conventional is typically the same thing. Folks with higher credit scores typically do well with conventional financing. From a cost standpoint, the conventional financing is a little bit lower because you don't have the upfront mortgage insurance premium that FHA has. So for conventional folks, the down payment would be 3% for first-time home buyers, 5% for repeat home buyers. With FHA, anybody can put 3.5% down. Conventional typically is a good product for someone with higher credit scores and has the minimum down payment at least. FHA is a fantastic product. What I like about FHA is that it is a great option for folks who maybe had a bankruptcy a few years ago, or lower credit scores, if they have high student loan debt and maybe their debt to income ratio is a little bit higher. So FHA is a good product for folks like that. And the interest rates can sometimes be lower as well. With VA, of course, you have to be a veteran. And the attractive thing about VA is that there's no down payment required for VA. And if you put less than 20% down, like with conventional financing, there's PMI. With VA, you can put 0 down and there's no monthly mortgage insurance. PMI is an acronym for private mortgage insurance. And the reason for that is because you're putting less than 20% down. So just to kind of touch on that briefly, your mortgage payment for most people is your monthly principal and interest payment, which is based on the amount financed and your interest rate. And then you have your property taxes. So 1/12 of your annual property taxes are going to be a part of your mortgage payment. And that money goes into a little piggy bank that we call an escrow account, so that the lender holds that money. So when your property taxes are due, they're paid in a timely manner without any additional cost to you, especially if your taxes have not gone up. And there's two other parts to that mortgage payment. There's your home insurance, because you got to have home insurance to protect your home. And then you have, if you put less than 20% down with conventional and always with FHA, despite down payment, you have a monthly mortgage insurance premium. And really, the mortgage insurance protects the lender. How does it protect the lender? If you put less than 20% down and for some reason, job loss, sickness, something like that, you're unable to make your mortgage payments, then the lender has insurance to cover its loss for the amount of money that was put down less than 20%. And so the nice thing is, when you have 20% equity in your property, then there's ways to lose that mortgage insurance and drop it so your monthly payment goes down.
What I was curious about is, how much do people generally qualify on a mortgage? Like, say somebody has the dual income, they're making $10,000 a month as a household. How do you know how much you might qualify for a home loan?
So debt plays such a key role. I'll never forget this story. It was a friend of mine's daughter. She was a single mom. She made about $36,000 a year, and she had no debt, and she qualified for a $180,000 loan amount. And with her down payment, she was able to buy herself a real nice townhome. And I was super happy for her, because I have so much respect for single moms. To answer your question, conventional financing will go up to 50% of the gross monthly earnings for W-2 wage earners. So if the monthly income is $10,000 gross, then $5,000 is the maximum allowable monthly mortgage payment. Or if there's consumer debts, then we chip away at that 5,000. We take out the cars, we take out the credit cards. Interesting point about student loans, not real appetizing, but it is something to know. Even if your payments are deferred, we still have to count 1% of the student loan balance for conventional and 0.5% for FHA as a monthly payment liability. So if you have $50,000 in student loans, that's a $500 a month payment for conventional financing, or $250 for FHA financing. So that takes a bite out of your affordability. And even if there's no payments being made, if it's deferred, we still have to count those. So the idea is that if you're making $10,000 a month between you and your spouse, significant other, and $5,000 is the limit on your debt load, housing and consumer debt, then that's what we're working with. With FHA and VA, we can go up to 55%. So I'm going to take $10,000. Yep. Times 0.55, so about $5,500. And that, shame that I needed a calculator to do that, but I didn't have my second cup of coffee this morning. So,
and like you said earlier, based on like what you can afford, like who in the right mind would want a $5,500 a month payment?
Well,
if you're making, like, that's crazy, because
that's the thing. And and I'll talk with clients, and they'll say, John, what's the maximum that I can afford? And I give them that sale price, and they go, wow, that's great. I can't wait to stop renting and buy a house. And then when they say, well, how much is that monthly payment? And I tell them that, then they might say, ooh, I don't want a payment that high. And that's fine, because then we can work with that to have a payment that you feel comfortable with and make the approval based on that price point, that sale price.
Yeah, and a couple times that I have seen people buy up to their max limit has been some like unique situations where it's like a husband and wife situation, and like, say it was a recent marriage, and the husband in this situation, they had a situation where they were recently married, and the husband in this scenario, he has a good job working for the railroad, somewhere around $100,000 a year income. She was like a nurse's assistant, making, I don't know, say 50-ish or something, and his credit got destroyed before they were married, and so they couldn't use his information on the account at all, so he couldn't be on the mortgage, even though they had combined income of like $150K. The only thing they could get qualified for was off of the wife's $50,000 salary. So they went all in and bought as much house as they could based off of her $50,000 salary, because they could easily afford it, because their household income was actually $150, but on paper for the lending process they could only show $50,000 a year. So that's one time where I've seen people, why it would make sense to go into maybe that 50% mark of a.
Well, sure. I mean, When you think about, like we mentioned, $10,000 a month gross earnings between like two people, or somebody asked me last week how many people can be on a loan application. I've had four people. I had two parents and two kids one time. So the idea is that regardless of how many people are on the loan application, if it's one or two or three or four, when it comes to the thresholds on the debt to income ratio affordability calculation, conventional will go up to 50% debt to income ratio. So if it's $10,000 a month income, maximum housing and consumer debt is $5,000. So if you don't have any car payments or student loans or credit cards, your maximum mortgage payment could be $5,000 a month. I don't know too many people that would want a payment that high, even if
Yes.
they're making $10,000 a month. But the idea is that the thresholds afford folks a price point that may result in a monthly payment that's higher than their payment tolerance.
Hmm.
So if someone says to me, John, what can I afford? And I tell them, and they say, well, what's the monthly payment on that? And I tell them that, and they say, oh my gosh, that's too high. We can structure that pre-approval around your monthly payment tolerance so
Hmm.
that you have disposable income. You're not a slave to your mortgage payment. You have money to go on vacation occasionally, go out to dinner, once in a while, that type of thing. So it's always a good idea to purchase a little bit below your affordability. Now, FHA, for example, will go up to 55%. Mathematically, $10,000 a month in gross earnings, and the maximum allowable consumer and housing debt would be $5,500 a month.
Hmm.
And so, if there is consumer debt, we chip away at that so that we arrive at a maximum allowable mortgage payment with taxes and insurance. Generally speaking, folks are happy with what they can afford based on paper, and the idea is just to make sure that they're comfortable with that payment.
Okay, cool. And can we talk about how much money do you need to buy a house? We got we just talked about how much house will I be able to qualify for, but how much cash do I need to have in hand in order to buy a house?
Absolutely. So previously we talked about the sources of where money can come from to purchase a home. But in terms of sheer dollars, let's say that you're a first-time home buyer and you can put a minimum of 3% down. On a sale price of $200,000, that would be a $6,000 down payment. FHA, 3.5% down, $7,000 down payment on a sale price of $200,000. But don't forget, there's closing costs.
Hmm.
So, what are closing costs? Well, most of them are third-party vendors. Currently guaranteed rate, your lender charges $1,640 to do the loan. Most lenders have either a flat fee or they break it down processing, underwriting. It shouldn't be much more than that. We're very competitive in what we charge, and that's right in the ballpark. But you have other fees. You have to buy a homeowner's insurance policy. Generally, they're about $1,400 a year. You have to purchase an appraisal. That's about $500. We would order the appraisal. Sometimes buyers think that they have to order the appraisal, but the way the government set it up is that the appraiser has to be an independent third party, not connected to the transaction, because we want an objective viewpoint of how much the house is worth that you're buying. As your lender, we want to make sure that the house is worth what you're paying for it. Some of the other costs that are involved: showing funds for property tax escrow, which is that little piggy bank that we talked about that you put in
Hmm.
money into each month so the lender pays your taxes when they're due. And then you have a title company that's involved in the transaction, usually hired by the seller's side. The title company does a lot of work for the buyer. They search and examine that title. They're responsible for issuing clear title to the property, so there's no other entity that has a lien or an interest in that property. They insure over property lines. We don't require that you pay $500 or $700 for a survey, so we insure over property lines. There's other endorsements that protect you and protect the lender's investment, so you pay for that. Title fees in the state of Indiana, maybe about $1,100, $1,200.
Hmm.
Illinois, by contrast, probably closer to about $3,000 or
Yeah.
$4,000.
Yeah.
So if someone says, okay, John, $200,000 house, I'm going to go with FHA. I'm going to need $7,000 for the down payment. How much am I going to need for closing costs? If you're buying in the state of Indiana, I would say a safe bet between about $3,500 and $4,000 in closing costs. And I'm referring to a primary residence. It's your primary property where you're going to live and go to sleep each night. It's a little different for investment properties. But the
Mhm.
one point that I wanted to make is that there's a term and an opportunity that buyers can take advantage of, and it's called a seller concession, or in layman's terms, a seller credit that the seller is willing to pay for your closing costs, or you can use it to buy down your interest rate. But for someone who's maybe tight on funds and doesn't want to use the very last dollar in their bank account, they can ask their real estate agent, they would ask you, can I get a seller credit for my closing costs? Now, if you're a strong buyer, then many sellers would consider this, right? You're an answer to their problem. They got to sell a house and you're the answer. So they may be willing to consider that. It saves you money on what you have to bring to the closing table, and it solidifies a contract. But make no mistake, if there's other buyers, then you're less attractive, less competitive as a result of needing the seller to pay your closing costs, all things being equal, like on the sale price and things like that.
Okay, cool. Yeah, so you got your down payment and then your closing costs are a separate pool of money. And I think a lot of people don't understand that, where it's like, they think it's all going towards the house. It's like, no, you got to put your 3 or 3.5% minimum towards the house price as your down payment. And then you have those closing costs on top, of which, in Indiana, we're $1,500 ish, Illinois, $3,000, and then you've got insurance and stuff like that on top of it. So that's what those different fees add up to be. So
correct. There's a lot of third-party vendors in these transactions, and most of them get paid the day that you buy the house. The only one that gets paid up front with guaranteed rate is the appraiser, because they are a third-party vendor and they get paid when they do their work, whereas everybody else gets paid the day that you buy the house. And it's an important consideration because, like you said, it's not just down payment, but it's closing costs. And those costs are very important to getting the transaction completed.
And we touched a little bit on this, but if you don't have all that money right now, you can get it as like a gift or those other vehicles you talked about, like possibly pulling from a 401k or something like that. So I guess point being is that if somebody knows they don't have the amount of down payment, then they could, and you got a stable income, but your savings just isn't there, it would still make sense to apply. And then someone like you could coach the person as to, hey, let's talk through other options. Can you get a gift from family, or, let's explore your 401k and things like that. So
you brought up a good point, and that is that a lot of times I'll get a call from someone that says, we're not in a hurry to buy. We're thinking of buying, maybe next year or later in the year, that type of thing. And really, it's super smart for someone to fill out the application, even if they're not looking to purchase for a little while yet. And the reason for that is credit reporting in this country is not exact. So let's take a look. Let's see. Is there anything that's not correct on your credit that needs to be addressed? Is there a skeleton in the closet? Is there an obstacle? Is there a roadblock? Is there something that needs to be addressed? And for something like assets and just having enough money in the bank to buy a house, I always tell folks, redirect any and all non-essential spending that you need to live and survive, and put that money into your savings account. Some clients have even opened up a separate savings account just for the home purchase. Yeah. And they do whatever they can. I mean, my wife always says, if you haven't worn it or used it in a year, get rid of it. And so sure, have some garage sales, redirect, any money that you can, and you'll be surprised how quickly you can save up the funds needed to purchase that home.
Yeah. And John, what states can you lend in?
So guaranteed rate is licensed in all 50 states. The 2 states that I do most of my business is Illinois and Indiana, but we're in the Midwest. And you'd be surprised how many people want to live in a temperate climate like Tennessee or Kentucky. I'm seeing more folks moving there. I also have a lot of clients that look towards Michigan or Wisconsin to purchase. For most of the other states in the country, I'm certainly able to assist. I have a team member that, can quote rates in that state, lock the interest rate, that type of thing. But essentially, I'm able to assist pretty much in every state that you may be interested in purchasing in.
Okay, cool. And then I just got a self plug also. I'm licensed in Illinois and Indiana. And then my EXP Realty agent brokerage that I'm with, we have referral partners throughout the United States. So anyone watching this looking to go anywhere, John and I would be able to either work with you directly or get you in the right hands of awesome producers in that area. So we submit an offer, we have your pre-approval, the seller accepts. Now what happens? Is it like,
good question.
I'm a buyer, am I out of the picture now? And I demand money just rains out of the sky at some point, or what happens?
Excellent question. And really, that's the time to lace up your gym shoes and get ready to start the sprint, because at guaranteed rate, our goal is to have you cleared to close as quickly as possible. And so what we always ask our clients is to please check your email inbox or junk folder multiple times daily and respond when necessary. Maybe it could be just clicking a consent button or electronically signing a document or providing documents that are needed. But here's what happens. When you send me the contract, we're going to go ahead and prep the file. We're going to trigger the disclosure process by putting in the subject property address, and then usually a good idea to lock the interest rate at that point. And then we send you documents to electronically sign. Those are what we call initial disclosures. The money to close is actually rounded a bit high because there's credits that are applied at the end, most notably the seller property tax credit. And so your final money to close will be much lower than the initial. But you sign those electronic documents, and then we'll send you a link to electronically pay for the appraisal. And then we'll tell you, here's the documents that we need for your underwriting. Typically 2 years of W-2s, 1 month recent pay stubs, 2 months recent bank statements, including all numbered pages. And it's essentially that proof of income and assets, which gets you the underwriting approval. Now, usually what I try to do when I issue the approval is say to folks, congratulations, you're approved. Please send me the following documents. And I ask for those up front so that we're not chasing those after you sign a contract. It helps the underwriting process be more efficient and more expedient. And so when you provide those documents, really about 48 hours later, it's approved by underwriting. There may be a couple conditions to clear the purchase to close. And once again, your responsiveness as a buyer helps us get you to the finish line quickly. And I can tell you some stories. We've had people cleared to close in just a few days or a week. Last week, I had someone that was clear to close in 11 days. I mean, that's fantastic. And even if your closing is 30 days away, what a great feeling to be done 2 weeks ahead of time. You know, it's a nice soft landing into your new home. There's no stress and anxiety the week before closing because you're running around trying to chase after something that's needed. We like to have you done as quickly as possible.
Yeah, I think one of the fastest experiences I've had, period, was actually a referral from you where you there was a client buying in Griffith, and it was from date of me calling her on the phone for the first time, the closing table was like 3 weeks. And I was like, what? Oh my gosh, it was so fast. I'm like, you're just kind of waiting for the shoe to drop in the process, but like it didn't. I was like, wow, this is crazy.
Yeah, when we issue an approval, start packing, start getting your boxes together and packing up all your stuff because you're going to be on your way to a new home.
Okay, cool. And then, all right, so, and again, just for sake of time, we'll just speed through some things here. But so like now closing happens, what should I expect after closing?
Great question.
You know, some things that I've come into mind too that I'll let you speak about is like you're gonna get all kinds of crazy mail, like what's legit, what's not, who do I pay? Like how does that happen? So you want to add that and then some.
Excellent question. So absolutely. Anytime someone buys a house, the next month is usually a skipped payment because interest is applied 1 month behind. So if I'm buying a house today, I don't make a June 1st payment. Today's May 29th, 2024. So if I'm buying a house today, I don't have to make a June payment. My first payment will be July 1st. What happens in that month in between? The title company is going to record your purchase through something called a warranty deed, and they're going to record that with the county. Now, there's many folks out there that look at the public record to see new home purchases. Now, none of your personal information is on the record, on the county record, but the date of your purchase, how much you paid, your interest rate, all of that is public information. And what happens is when new home buyers get into their home, in just a couple of weeks, they start getting a ton of, mail, mostly mail, sometimes email, and it's solicitations from all different types of companies, mostly insurance companies that want to sell you a policy to pay off the mortgage in the unlikely event of your death. And there's a few other companies. And so I tell my clients, look, just because you got the keys to your house, I'm still happy to hear from you. I mean, I've had great friendships with folks over the years. Feel free to call me at any time. Send me a text picture of the document that you received that's confusing. And funny thing is, I just had this happen the other day. Someone sent me something, and the solicitor put guaranteed rates information on the top of the letter.
Oh, geez.
So that the new homeowner thought that that came from our company and thought that he had to act on it. And I said, thank you so much for bringing this to my attention. That's a scam. That's junk mail. That's, not someone that's affiliated with our company. And so I'm always happy to take a look at stuff. And you'll receive a welcome letter with your monthly payment information, usually in about 2 weeks after closing. We can certainly facilitate that. But the idea is that when you receive that and you see who you make your monthly payment to, just keep making those payments on time, and you're going to have a great investment for yourself that continues to grow in value every year. It's just really the best thing ever to see folks, improve their financial situation, improve their family life by buying a new home.
Cool. All right. Thanks, John. And just to wrap this up, let's do a fun story or two. I'll tell a quick one that comes to mind, and then I'm sure you probably got some crazy ones. I had a buyer he was communicating with the title company as needed for some, closing logistics, and they use this secure portal. And so he had his wire instructions and everything. And then like the day before closing, he gets an email that wasn't via the secure portal, but it looked exactly the same. It had the same people's names, like the email address showed as the same. And it said like, attached is your revised wiring instructions. And so luckily he didn't obey that. He called the title company and said, what's this? And they're like, no, that's not from us. And so had he not fact checked that information, he was wiring $320,000. And had he not checked that, that could have been gone. Like that money would just, you can't really get that back once more.
Well, that's true. And, until recently, folks were vulnerable when they responded to digitally communicated wire instructions, because in this country, what happens is that a criminal would intercept that email and they would put their own routing number on there. And then, yes, as soon as the buyer or even seller on proceeds from the sale clicks the enter button and uses that routing number, then their money goes bye-bye. And so with Guaranteed Rate, in my email signature, it talks about wire fraud. And what I tell everybody is, if you're wiring money, you initiate a phone call to the title company and you get the wire instructions, which is basically their bank name and routing number, and you obtain those verbally, or you can drive to the title company and obtain them face to face. Never ever act on digitally communicated wire instructions, because we don't want to see anybody lose a single dollar. The couple of stories that I have to tell are less to do with technology and more to do with the buyer just making a really silly mistake. When we send out a pre-approval, I attach a document that says protect your pre-approval, and it talks about the do's and it talks more about the don'ts. So here was a young fella, he got cleared to close on a Friday and he was closing the following Wednesday. He hated his job, hated his boss. So rather than call me and ask me if it was okay to quit his job on Saturday, he just decided to quit his job on Saturday before the Wednesday closing. One of the things that our quality control department does is the day before closing or the morning of, sometimes they'll call the buyer's employer and say, hey, still employed, still working? Yep. Okay, thanks. Well, in this case, the employer said, no, he quit his job 2 days ago. And he was not able to buy that house.
Wow.
I've had other folks where they decide either the day before or even the day of closing that they're going to go out and buy a super expensive car and get themselves a nice $500, $600, $700 monthly car payment. And what happens there is, we, the lender, the investor, we monitor your credit mostly because we want to see, are you applying for multiple mortgages on the same property, which is not allowed. But occasionally you'll have someone that is clear to close. They're planning on closing tomorrow. So they decide that they're going to go out and buy a car today and get a brand new, big fat monthly car payment, which could mess up their debt to income ratio and result in the mortgage being declined. We always tell folks, just wait till a couple of days after buying a house if you have to buy a car. But at the same time, just make smart financial decisions, because you don't want to buy a car the day after you buy a house and have a big car payment and now you're struggling on the mortgage payment. So just give me a call. Just ask me what you're thinking about doing and we can work out the numbers and we'll let you know if that's a good idea or a bad idea.
Oh, cool. Yeah. I asked where I have a lot of title on closings, that I asked the title agent one of their worst stories, and she was like, well, the most memorable one is that we go to closing, it's this guy and girl are buying a house together, they're not married. they're at the table and they find out, and the girl finds out the guy's still married. Like he didn't know. It's like,
Well,
oh,
I had a similar situation too, because the girlfriend was there, and this was in Illinois where they have attorneys and they use attorneys, and the attorney said, "Well, your wife needs to sign the document," and it was assumed that the girl there was his wife, and the guy said, "Well, my wife is not here right now," and the attorney said, "Can I speak to you in the hallway?"
oh wow. Oh, great. Cool. All right. Well, John, appreciate your time today. We'll have your information, your approval link, and your info, yeah, listed link below here. And appreciate your time. Look forward to closing lots more deals with you in the future.
Tony, my pleasure. Thank you very much.